Hey guys, what is going on? Welcome back to the portfolio. Welcome back to the channel. For today's video, I want to do an update review of all of the options contracts that expired this past week, a full week of options contracts and premiums that were credited to the account. Overall, $26.92 to the account for the last 1 week's worth of trading. All of those options premiums will stay in the portfolio. The next week, I'll do another round of contracts. Again, hoping to get about around the same amount, if not higher, this week moving forward. First, let's go ahead and dive into some of these contracts. I know a lot of you guys were wondering exactly what I'm doing on the portfolio, so I just wanted to do a quick breakdown of each of the contracts, the put sells as well as call sell contracts with the portfolio. So let's go ahead and break down each of these options, both the put as well as call contracts. I know in the prior video, a lot of you guys wanted some more detail on exactly what's happening with these contracts. So I decided to break it down very simply here, taking a couple of the contracts and talking about exactly what we're doing. I'll be only talking on the side of selling off the contracts, receiving a premium to the account. On the flip side, you can buy these contracts. You'll essentially have to use cash in your portfolio to buy these contracts. That's a different way of trading, and I'll talk about that on a different video. For this video, we're simply only talking about selling off the contracts to receive a premium to the account. So let's go ahead and start with put options. Up on screen here, you can see one of the contracts that expired on Friday, 2/12, Tesla 805 put sell 2/12. So essentially, this is a contract that sold off to another investor to receive an options premium to the portfolio. For this particular contract, I received $505, essentially $5.05 per share. Each contract is 100 shares. One contract was $505. And what this is doing is obligating myself to buy the stock if the price of the stock decreases below the strike price, which in this case, up on top, you can see 805. That is the strike price. So if the price of the stock gets below that, I'll be required to buy 100 shares, one contract's worth of stock at 805. And I'll have to do that by 2/12. So any point up until 2/12, the buyer of the contract can obligate myself to buy the stock at that price again if the price of the stock gets below 805. And I did have a couple examples here. Hypothetical example. On the left of the screen, you can see the price of the stock. On the bottom, you can see the dates, including the expiration date 2/12 on the right. So for this particular stock, let's say the stock continues to trade above the strike price of 805. Nothing will happen on 2/12 on Friday. The contract will simply expire, disappear, and you keep that 505 premium. If the stock does drop a little bit below the strike price, it really depends on when it happens. When it does drop below 805, at any point, the buyer of the contract can force you to buy the stock for the contract. You're obligated to do that, but my experience has been it only depends on Friday. If the stock does drop below 805, I've never had a contract execute up until this point. It really depends on that expiration date of 2/12 if the price of the stock is above or below that. So for this example, while it did drop below 805, rarely, and for my experience, it has never executed. If it gets back up above 805 on Friday, nothing happens. The stock contract simply expires. The options contract simply expires, and you keep that 505 premium. However, if the price of the stock does dip on Friday, for example, here it dips down to 720 on 2/12, the expiration date of the stock, you will now be required, or I will be required, to buy the stock at 805. So the buyer of the contract would want me to do this because essentially the stock is 720, but they can sell it to me for 805, making a profit on that trade. Again, I hope it stays above 805, so the contract simply expires and I keep that options premium. For call contracts, it's a little bit different. It's actually the opposite. So as an example, again, up on top here, I have one of the contracts that expired on Friday, BA Boeing 240 call sell 2/12. Again, just like the put sell contract, this is a contract to sell off to another investor for an options premium payment to the portfolio. For this contract, I made $72. Now I'm obligated to sell the stock if the price of the stock rises above the strike price. So a little bit different in the last scenario. The strike price here is 240, and again, the expiration date is 2/12. So I have the stock in the portfolio. If it does get above, the price of the stock does get above 240, I'll be required to sell off my stock to another investor for 240. And again, here are some examples. Again, the strike price here of 240. For this hypothetical stock price, you can see it never gets above 240. So I'll never be required to sell the stock to another investor for 240. Likewise, if it momentarily gets above 240, my experience is that the buyers of these contracts never execute these contracts. I've never had a contract execute during the week. However, if on the expiration date the price of the stock is above 240, then I'll be required to sell the stock off to another investor at 240. Again, for the investor buying the contract is now worth $270 in this example, but I'll have to sell off to them at 240. So that's how they make money on the contract. Again, I hope the stock price stays below 240. The contract simply expires and I keep the options premium on the portfolio. Let's go ahead and jump into each of these contracts to show you guys exactly the premium that I'm receiving on the portfolio. You can see here Apple AAPL 133 put. As you guys remember from the discussion, if the price of the stock stays above 133, nothing will happen. The contract will simply expire and I'll keep that $1,000 premium as you see in the middle of the screen. The current share price is $135.30. So it looks like when this contract does expire, it'll be above that price. Nothing happens. I simply keep that $1,000 in the portfolio. You can see position there. I sold off 10 contracts. Each contract is 100 shares. So overall, 1,000 shares with this contract. The next one, again, this is the flip side of a put sell. This is a call sell with BA Boeing, 240 call. You can see in the middle, I have 12 contracts. Again, one contract is 100 shares. So I am putting contracts on for all 1,200 shares of Boeing that I have in the portfolio. In doing so, I receive an options premium to the account. And for a call contract, if the price stays below the strike price of 240 for this contract, you can see currently 211. Nothing will happen, and I'll keep that $72 premium as you see in the middle of the screen. So what I'm hoping is that the price stays low, does not get above 240, and it simply expires. Here's another contract with Tesla TSLA 805 put. Again, if the price of the stock gets below 805, I'll be required to buy Tesla at 805. You can see again, currently the share price is 817.01. I sold off 2 contracts, 200 shares, and if the price of the stock stays above 805, I will simply keep the options premiums that were credited to the account, and the contract will simply expire. And on the bottom of the screen, you can see 2 separate premiums, 505 and 565. Both of those premiums were credited to the account. And since, again, the price of the stock looks like it will stay above 805, these contracts will simply expire, and I will keep 505 and 565 in the portfolio. And the last one here, a 775 put, Tesla TSLA. This is, again, a put-sell contract. If the price of the stock, again, stays above that strike price, nothing will happen. The contract will simply expire, and I'll keep the options premium that was credited to the account. As you can see on the bottom here, another $550 was credited to the account. So again, those are all the contracts here. Put contracts as well as sell contracts for this week, $26.92 premium income credited to the account. And really what I'm doing every week is simply hoping these simply expire, and then I free up the capital as well as the stocks that were contingent on these trades, and I put another round of trades in, again hoping to get around anywhere from $2,500 to $5,000 per week using this method. So I just wanted to quickly go through all the options contracts here. Let me know if you guys are doing a similar strategy, if there's any way I can improve this, or if you guys are also doing it, what has been some of your success. In particular, what stocks are you using this strategy with? Again, I'm using Boeing, Tesla, CGC, as well as Apple for all of my trades. No CGC trades this week, but hopefully next week I'll put some in. So again, just want to do a quick update. Again, if you guys enjoy the content on the channel, if you guys enjoy the video series, feel free to like, share, and subscribe. Until next time, we'll see you then.